Welcome to Rise Up, where we take a really good look this week at breaking down all the stories that apply to you. We really want to help you grow and protect your portfolio. My name's Terri Kallsen, and I'm a managing partner at Rise Growth. I'm also a certified financial planner, and I'm joined here with my co-host, Joe Duran, who is also the founder of Rise Growth Partners and an amazing entrepreneur who really led one of the largest RIAs and fiduciaries in this country. Joe, thanks so much for joining us.
Hey, how are you today, Terry? Here we are going into President's Weekend. I don't even
Yeah,
feel like the year has started, so I don't know how we got here so quickly. But I know up in your neck of the woods, we're on the West Coast here getting bombarded with rain. My daughter's in New York getting hammered with snow. So I think we're in the real teeth of winter here and all
absolutely.
looking forward to a nice long weekend.
Yeah, well, it's really appropriate, actually. We have a new president, so we might as well celebrate on President's Day. So I know my family and I, we hope to go skiing over the weekend because all this rain does really lead to great snow up in the mountains here in Northern California. So I hope everybody else is going to have a great weekend as well. We also have two other guests with us, Scott Schwartz, who's a certified financial planner and a principal at Bleakley Financial Group. And we have Peter Boockvar, who's the chief investment officer at Bleakley and the editor of a very popular book called The Book Report that's available today. Peter and Scott, thank you for joining us.
Thanks for having us.
Great to be here. Thanks.
All right, let's jump into the biggest stories of this week, which of course was the jump in consumer price index, rising 0.5% from December to 3%. The news really set up a ripple effect, starting with the markets as the S&P dropped 3% on the news. It also bounced back on Thursday, but we also have the 10-year Treasury yields that added 10 basis points on Wednesday, reaching just short of 4.64, which is the highest in 2 weeks before falling back the next day. Food and energy, which we're hearing about in the marketplace, biggest drivers of CPI, which was up 0.4%. And so many of us were hoping that inflation would start going down. That was really the hope for the new year. So, Peter, I'd really like to start with you. Obviously, this news is going to keep the Fed pretty cool about lowering interest rates, but there's another outlying factor out there watching how the new U.S. policies on tariffs are going to affect the economy. President Trump is announcing so many things. I think he's flooding the zone, but it's really a 25% tariff on steel and aluminum products coming into the U.S. Peter, what do we think of this?
Well, inflation has proven to be pretty persistent. It seems to be stuck at around this 3% level. And with the Fed's target being 2, it's still stubbornly well above that. So it does put the Fed on hold. Jay Powell did speak in front of both the Senate and the House this week, and he did say that they're in no hurry to cut interest rates again. And the inflation data, both CPI and then the PPI on Thursday, certainly confirmed that he should be sitting on his hands. So the question is what can break inflation lower? And an onslaught of tariffs would not do that. It would probably keep inflation as is or even shift it higher. So it's more of a cloudy result when it comes to inflation, and interest rates are going to stay persistently at current levels following the inflation numbers.
And Peter, I mean, I'd add the inflation is where people really notice it right now. Eggs pricing is out of this world, even though it's really driven by the bird flu. It has an impact on everybody's breakfast. Coffee, new highs. These rents, new highs, like the things that are really visible in people's lives, which I tell you, you see it here in California. Maybe it's anecdotal, but I noticed that with the Super Bowl, they were giving away hotel rooms in Las Vegas this last weekend. I didn't go, but they were rooms at the Wynn and really luxury hotels at $150, $250, which this weekend is typically completely out of reach. So I am wondering if we're starting to see a little bit of, is this economy cooling? I noticed actually in the speech that was given by the Fed, the economy is doing great, but I am starting to see some anecdotal. It's easier to get a reservation for dinner. Last night, I was able for tonight, prior to Valentine's Day, get a reservation at a restaurant very easily. It just seems like maybe it's just in California, but it seems like the inflation is really hitting people where it matters. And I just wonder if you think there's a concern about the economy slowing in here, because that combination obviously has huge implications for investors.
Well, it's definitely been a very bifurcated consumer. We know the lower to middle income consumers gotten whacked pretty hard, and we're still seeing stress on their pocketbooks. They're focused more on their needs, less so on their wants. The upper income consumer has done much better because they're able to absorb the inflationary pressures much more easily. They've been shifting their spending to more travel and leisure and away from goods. But it does highlight, as you mentioned, a very mixed and uneven consumer because of the cumulative impact on inflation that is very painful. And at best, wages, which have risen pretty nicely, are really only just keeping up with the level of inflation when you look at it over a multi-year time frame.
I know you're a planner, Scott's a planner. What do you tell your clients in a day-to-day inflationary environment? How does that play into a financial plan? Like, at what point do you say, hey, we've got to change our expectations? Obviously, people who are in a fixed savings, inflation eats away at their possibility of what they can live in retirement. So how often should you take a look and say, hey, what does this mean to my retirement? What does this mean do I need to work a few more years? So how should an individual think about that?
Yeah, we spend a lot of time talking to our clients about liquidity. We spend a lot of time talking to our clients about, how much money do they spend? What's coming up on their time horizon? I review with my clients every quarter, and the first question I ask is, how are we doing cash flow wise? And is there anything coming down the road? We spend a lot of time in this business talking about where did the market close today? What are the numbers on unemployment, et cetera? And this is kind of Peter's bag. While I think it's important, I think sometimes our clients are a little too focused on that. At the end of the day, we're very well diversified with our clients. We want to own equities because we know we're going to have inflation over time, and we want to have growth to keep up with that inflation. But I think more importantly, we want to recognize the fact that as things are getting more expensive, we have the liquidity available. If my clients are going to need to spend more money next year to live, I want to make sure that I've got that money set aside, in fixed income, in cash, in treasuries, so that we're not forced to sell securities in an environment. If we get into a really tough market where things get really expensive, my clients, I don't want people to be in a position to have to sell securities, sell equities. But that's our take on it.
Yeah, Joe, I just wanted to say, if you're going to take your wife, Jen, out for Valentine's Day, I just had dinner in California just this Tuesday, and the restaurant was completely out of chicken. So you and Jen did not expect to have chicken for Valentine's Day. And I think that was bird flu related, but that's the first time that's ever happened to me. So order something else.
All right.
I'll add something of value on Valentine's Day. My wife apparently was reading somewhere that the origin of Valentine's Day is really pretty dark and bleak if you were to look it up. So we're not going out for Valentine's Day. We're just going to hang out at home.
Go out for President's Day, because that's even a better day. That's what I would do if I were you, Scott. But let's talk about the Mag 7, right? Is the Mag 7 now the Leg 7? I don't know. But the S&P, ended end of day Thursday up about 4% as of last Friday. Germany is up almost 13%. UK is over 6%. So we're starting to look at some changes in the economy. But, Scott, a few weeks ago, you mentioned Bleakley clients were asking all about the Mag 7 and where we are now. What are your thoughts on that?
So we've always been, long-term focused, right? We're financial planners. We're not market timers. Again, we all kind of get caught up in the current news, and our clients are excited when they look at the last few years with what Microsoft and NVIDIA and some of these, this Mag 7, as you call it, have done. Look, the last few years, we have exposure to those stocks, of course, but we've also had exposure to non-US equities. And quite frankly, as you're talking to your clients last year, the year before, and you've got a non-US equity position, they lagged. So, I heard somebody once say that being diversified means always having to say you're sorry. But in the end, you want to be diversified. So what's happening now is these stocks that are trading at much lower multiples, whether you're talking about healthcare, whether you're talking about mid-cap stocks, whether you're talking about non-US equities, they're starting to lead. And that's encouraging. I think, from our perspective, seeing the market not so heavily dominated by 7 names is encouraging. Now, we still want to have exposure there. And if you've got money in the S&P 500 or in any large cap domestic equity fund or the Russell 3000, you're getting plenty of exposure to these Mag 7 stocks. My recommendation would be to people, Don't chase it. Don't feel like you've missed it. You don't need to go out and buy those stocks on top of your portfolio and be overexposed there. There's still good value out there. We like healthcare. Like I said, mid-cap stocks starting to perform better. Small-cap stocks could likely perform better, particularly if tax rates come down. So yeah, being diversified, owning good quality assets in the long run is always a good idea.
There's been a really diversification within the Mag 7 too. Meta's hitting all-time highs. Tesla, I think it's down. I think it's had a really good run the last 2 days, but we were almost down 30% from 500 to 330 since the election post result. And so when you're at these valuations, and all of the Mag 7 have very lofty valuations. We saw what happened with NVIDIA, even though they've had very nice results. And Peter, I think we talked about this a few times, that you can own the S&P either as a cap weighted or as an equal weighted, or you can, instead of owning just the S&P 500, which again heavily weights the Mag 7, you can also own the Russell 1000, which is also the middle cap names. And in fact, if you take the S&P without the Mag 7, it's up about 2 or 3% more than with the Mag 7. So we're starting to see, for the first time in quite a while, the companies that have not participated as much doing better, both on the downside when the markets go down and also when the markets are going up. So again, we've had these head fakes before. It might go back to being the Mag 7, all about the Mag 7 again, but we are seeing some noise. And I think the other thing you have to point out is that when you have 7 names and only 7 names with very high valuations, if one thing goes sideways in one of them, it can have an impact across the board. So, you look at Tesla, there's very little daylight between Tesla and the president right now because of the role that Elon Musk has in Doge. And whatever your opinion is, good or bad, it certainly might be taking attention away from the fact that Tesla's cars are now fairly mature. They need a new cycle, and he might be spending more time trying to figure out how to save billions of dollars on the US economy than figuring out what the right next car is to be successful. And then you have the second impact, which is not small, which is the political backwash. There might be more people in the center of the country buying Tesla trucks, but there's also maybe fewer people on the West Coast and East Coast buying Tesla cars. And so all of this stuff just speaks to the fact that you want to have a diversified portfolio. It's interesting to have an interesting stock or two that you are a fan of, but you want to, if you're going to be a serious investor with your serious long-term wealth, your life-altering wealth, you want to be very thoughtful about not over-depending on any one thing working out, and always being a little disappointed, I guess, as Scott's saying.
Can I just add something? I'm sorry, Peter. Just one thing to what you just said is a very good point. You have people out there who are just buying indexes because they think they're really well diversified and that's where they want to be. But the truth is that the indexes have gotten very, very heavily skewed towards these big names. One of the things we do at our firm, we're very careful to do, is we buy specifically a value position, a growth position, a mid-cap position, a healthcare position, and we look at those positions. So we want to make sure that we're well diversified, so that when these stocks are out of favor and these other assets that have been undervalued come back into favor, that we actually own them, right? So I think it's important to understand, what do you really own in these baskets, because they have been somewhat skewed by these big market cap companies.
It could. I'm going to tie Valentine's Day into this. The market may be losing its Mag 7 Valentine in terms of their dominance in driving performance. It's really down to the Mag 1. Joe, you mentioned Meta. Meta's stock is up 19 straight days, while the other 6 have sort of now more challenging fundamentals. You mentioned Tesla. Apple hasn't seen any growth, and the others, the big hyperscalers like Amazon and Google, are spending extraordinary amounts of money that investors are now beginning to question whether they're going to see returns on that. It's sort of a post-DeepSeek response, which is good for the rest of the market because maybe investors can now find other things to buy. And Scott talked about diversification, and I think if the market loses those top 7 stocks, and just to quantify, the top 10 stocks make up almost 40% of the S&P 500. For comparison, in the previous peak 25 years ago, of the tech peak in March 2000, the top 10 stocks made up about 27% of the index. So I think that's why international stocks have started to outperform. Investors are looking to small and mid cap. So there is not necessarily a broadening, but a shifting of attention away from those most important stocks, sort of losing the Valentine and trying to find a new love.
Yeah, they're going to have to find a new love, and especially around the electric vehicles or the Teslas we talked about, 30% down from its December highs. I mean, when you think about the tax credit on the electric vehicles and the 7,500 that, our viewers can get back if they bought a Tesla in 2024, that's up for air. That's up for grabs. And so that also is causing people to really question if they want to buy another Tesla in their car. But let's move on to another great topic from the week. This is really the DEI, the diversity, equity, and inclusion. Is this dying in our government, in our corporate industry today? We're seeing large companies pulling back from investors complaining about money being spent on diversity programs. We just saw Goldman Sachs pull back in this area. President Trump signed an executive order, which for many things asked federal agencies to identify public companies that are working towards DEI programs and potentially prosecuting them. Disney's this week also started pulling back, but there are companies that are standing behind their DEI programs, like the NFL, for example, just came out. Apple, Microsoft. I know that Costco is another one. But, what do we think about this take on DEI, and how should investors be thinking about this in their portfolio? Joe?
Terry, I was at Goldman Sachs as a partner there right after Black Lives Matter really put DEI at the front and center. It was already a movement that was happening as an undercurrent, but it really, really magnified after Black Lives Matter. And I actually was on the DEI committee for the Wealth Group, and there was absolutely every intention of figuring out how to make it more inclusive. That was the initial. It was really about listening to what people that were having experiences in America that were different than other people and hearing that. That's what the original intent was. It then turned into action. And without getting into politics and which side of the aisle you're in, there's even been challenges now about the legality of how much differentiation is happening within corporate America. I can tell you what I saw happen, certainly at Goldman Sachs, is that they realized that they had to create an equal balance field, and that they had done a lot of work already to promote different groups. But I think what changed in the last few months is that the legal system is now saying you cannot apply these kinds of standards. And so certainly with Goldman's most recent move, and I'm not speaking as an insider here, just as a public reader now, and an investor, that they now no longer require that you have to have a minority representation in order to have an IPO on the board. It used to be you had to have at least one member from a diverse group on the board. They've removed that. And I think that is, as well as not great policy on their part that they've decided to amend for whatever reason, it's also true that they're not sure about the legality. I think that's the main reason, is that the courts have said you cannot apply a filter. And so I think what you're seeing now is everyone sort of calibrating without wanting to not include and elevate all the people on their team. And so I think we're in this very messy middle right now. And clearly the president has a very strong view on this, again, regardless of what your opinion is. But the courts are also questioning, how far can you take it? And certainly I was speaking to the dean of the business school at UC Berkeley, my alma mater, just last week. And she was saying they have no filters at all. And if UC Berkeley, one of the most progressive colleges in the world, cannot apply any diversity filter, then it's interesting. I can tell you, interestingly, they do apply an income filter. So I don't know if that's even going to be permitted, but for now, even the most liberal schools are realizing that they cannot apply some of the filters they might prefer to have in place.
Thinking about Berkeley, I've run the Berkeley Marathon probably 10 times in my life here. And it is one of the most beautiful schools that I've been, but like you said, also one of the most liberal schools as well. I want to just talk about our next big topic. And for me, I'm kind of excited about this topic because I think it unites all of Americans, and that's our tax time. April 15th, 2025 is our tax commitment day, our tax day. And, sometimes people think taxes are stressful, but the IRS is really trying to make a lot of changes to improve the overall experience. Hopefully it won't take as long, there won't be as much fraud and so on. So there's a lot to talk about for 2025. And we wanted our viewers to hear this early in February so everyone's ready, to actually apply by April of this year. But the first question we have, and I want to talk to the group about this, every year there's opportunity for higher contribution limits for 401ks, RIAs, Roth IRAs, which are after tax, 403Bs, 457 plans, all of those out there designed to help us achieve our retirement goals. And so what are the changes going on? So I wanted to talk a little bit about this, and I'd invite you guys in, but the deferral limits have been increased, $23,500. That's an extra $500. And if you're 50 or older watching this, you can add another $7,500. So you can actually save almost $30,000 in one of your 401ks or your 403Bs. And there's a special catch up if you're 60 or older. So for those of you who are listening, there's another $11,000 that you can actually contribute. So the traditional and Roth IRAs, the contribution stays the same at $7,000, but if you're 50 or older again, it's another $1,000. So there's a lot of opportunity to save. Scott, I wanted to ask you, how are you working with clients to really take advantage of these tax saving opportunities?
Yeah, so we run a lot of qualified plans. So, cash balance plans for our clients who own businesses who want to put a lot of money away. Of course, 401k plans, profit sharing plans, we're always very careful to see how efficient the plan is. But as you were talking, Terry, it made me think of something. So the limits have all gone up, and that's a good thing for most of us, right? Who feel like, yeah, I can put some more money away pre-tax, save tax dollars this year. From a planner standpoint, though, long term, one of the things we spend a lot of time looking at is where are we really saving our money? So the one trap that some people fall into is, particularly people who are a little wealthier, is that they're encouraged by these higher limits. They throw more and more money into their qualified plans. And what they find is in retirement, they might not be in a significantly lower tax bracket, right? So, the qualified plan and taking the deduction works great, assuming that you're in a lower tax bracket. Because remember, when I take the money out of that retirement plan, ultimately I'm paying ordinary income tax on all of it, not capital gains. So what we spend a lot of time in our practice looking at is long-term plan. Where are you going to be ultimately? You might be collecting a pension, Social Security. You might have a large portfolio that's throwing off income and dividends. So we want to make sure that we're not encouraging people to put more money into qualified plans where they're going to have more money that's going to ultimately be taxable.
So Scott, I want to just highlight this one because this is one of the blind spots I hear incessantly, because the media tells everybody, save as much as you can in your retirement plan. And if you are a medium or low income person, that is true. But if you're a high income individual, if you have millions of dollars and your income, you're generating income from your portfolio, even if you don't have a pension plan, and you're generating dividends and you're generating distributions and bond yield payments, it's easy to get into the higher tax bracket. And then you don't benefit from if you took that same money and invested it and it grew and you paid capital gains at the end or invested it in municipals. You might actually not be in a better place in a tax situation. And when you die, I believe you get taxed a second time because you have an estate tax on top of it potentially. And so it is true. It's a great savings vehicle if you're accumulating savings, but if you already have a lot of savings, the answer is not always max it out.
And Joe, to your point, I had a conversation with a client a couple of days ago. We were looking at where all their assets were, a new client actually, and we're flip-flopping their assets. They had a bunch of equities and IRA accounts, okay, and he's an older guy, and mostly fixed income and treasuries and their non-qualified accounts. And what I helped him understand, the reason why he's doing business with me is he's not likely going to spend this money. So growing all this money in his IRA account, not only is it taxable, he would have got a stepped up basis in his personal account on equities. Ultimately, he passes, that he leaves to his kids, there'll be zero taxes. As he accumulates all these equities and all this growth in his IRA account over all this time, his kids are going to pay ordinary income taxes on all that growth when it comes out. So yeah, I would say great that we can put more money away. For some people, it's going to be an excellent opportunity. For other people, they should be a little more thoughtful about, where are we accumulating our money and what assets are we getting where. Sometimes you could have too much money in your IRA accounts.
And Terri, obviously, one of the biggest questions this year is what's going to happen with the tax.
That's
the original tax plan that Trump had put in several years ago. It expires this year. So,
that's right.
And it's not just for estates that it could be a massive impact, because we're today at, I think it's 25 million you can pass on.
Yep.
I think it reverts back if it doesn't get extended to like $2 or $3 million.
Yeah, it goes backwards. Really, it's really, this is such an important topic for everyone, because in 2017, President Trump put in a number of different tax changes to really lower taxes on income as well as estate planning. And he did that for a couple of different ways. He did higher standard deductions, which makes filing taxes even easier, and you can actually keep a larger portion of your income shielded from tax. He also improved the qualified income business deductions that made it easier for businesses now to qualify up to 20% of their qualified income to reduce taxes. And then, as you mentioned, Joe, the estate and gift tax changes have changed considerably. And really, it roughly doubled the exemption, say that 10 times fast, the exemption amount for estate and gift tax. And those were decided to be permanent. But if this doesn't happen, there will be a significant change to what people can leave from a wealth transfer standpoint. And Joe, this is actually true and dear to me with my family. My parents, my dad is 88, my mother is 84. I helped them build their estate plan, their wills, and this has been since 2017. And so I'm working with them. I was just home last weekend looking over their files, making sure we're still current, but helping them understand if President Trump doesn't change this tax exemption for estate planning, we got to go backwards and do it all over again. So they're not very happy about that. So I'm hoping that President Trump will continue these. He says he has, but everyone, all of our viewers need to be very aware of this, because they are set to expire at the end of 2025. And if Congress doesn't act to extend that, everyone should go see their attorney as well as their certified financial planner in their life, their advisor, so they can make sure they've got their tax bills set up. But 2025 right now, this year, is a good year. It's lower tax rates, higher standard deductions, really more deductions for pass-through business income, and really a reformed AMT. If you recall, the AMT tax, there's less people with the burden of AMT tax. So we'll see what happens by the end of the year, but start thinking about this now as you think about your future in taxes.
One of the things on that note, we do have this large credit right now, and that exemption can be used either after you die or before. So look, I'm pretty confident that they're going to extend these taxes, these tax rates, I should say. In fact, I talked to my trust and estates attorney, who's a pretty smart guy who talks to a lot of folks. In their world, a lot of people think they're actually going to extend that credit to an even larger number. But one thing you can do in 2025, if you're not so confident, you can give that money into trust. There's certainly trusts out there where you can control your money, remove it from your estate now, so that if the credit does go back to those historically lower numbers, you've gotten the money out of your estate. And if the, if the exemption amount goes up, you can do a little more planning later. But people still do have time to do some planning if they're not, confident about that.
Yeah, I think that's a great point, either before or after, but have a plan, right? I think that's the most important piece. And just one more thing on taxes, because I can't give this up, you guys. I just think this is so fun. But, just a little trivia for you.
Hey,
on average,
spoken like the CFP chair. You are, as the chair of the CFPs around the world, you need to say that.
Yeah. Well, the IRS is really trying to improve the overall experience. They've actually invested a lot of money in their direct file program, because today, the average American today spends 13 hours and $290 to file their taxes. And so, they can actually reduce that amount through electronic filing. And last year, only 12 states qualified for the direct file, which is a much easier process with fewer mistakes. And now it's 25 states. So they've doubled the number of states that direct file is available to. And I highly encourage our viewers to check that out because you'll get faster service and you'll get quicker response times if you use that. And just so you know, most of the time, if you're getting a payment, if you're getting a tax refund, if you direct file, you'll get that within 21 days. So, you know, nobody really likes to work on their taxes, but if you get money back in 21 days, maybe you can go on a spring vacation or a summer vacation.
Or you can go to the grocery store and buy eggs.
That's right. That's right. Oh, good. All right. So let's go on. Now we're going to move on to the 3 big stories to watch for the coming week. You know, Peter, there's a lot of housing data that's coming out this week. Housing starts, builder confidence and permits, existing home sales. What are you looking for here?
It's actually, as you mentioned, those numbers, but it's somewhat of a break from a heavy data week this week with the inflation stats, the week before with jobs data and other sentiment surveys. So I think it's going to be more of a focus on continuation with fourth quarter earnings and everyone on their toes when it comes to any details with respect to tariffs, because that's been an ongoing attention getter every week, and what that means in terms of flow through, in terms of corporate earnings and impacts on overseas economies. But it's going to be at least a step down in terms of news flow, which I think the market would welcome.
I also think, you know, it's been a big earnings. We've been in the peak of earnings. I think we start to get a little bit more tranquil here, and hopefully start getting some good economic growth in the mix. And again, we'll always be looking out to see what the president does next. Hopefully it'll be quiet on Monday so we can all enjoy a nice vacation.
Well, he should take a day off, don't you think, on President's Day?
I think so.
You know, we should ring the White House and say, hey, buddy, you deserve a day
Maybe
off.
he'll play some golf on Monday.
Yeah, there you go. Then we can all
Hey,
enjoy.
I just remember the last presidency, it was like the media would go on and on about how many hours he was watching TV. And now it's amazing. Like, it's a turnstile of business leaders that are going through the White House right now. Like, we just had the CEO of Verizon go through. It is every day there's a new CEO coming in. It's very clear the White House is open for business. It's very clear that this is we want to hear and do things, and they're not resting and talking. Like, I don't recall in my 30-some years as an American, more movement in the first month of a presidency ever. It's almost maybe because we've never had a cycle where presidents come in, left, and had the opportunity to come back in and say, well, this is what I'm doing differently. But I think we were 9 months before he had his whole cabinet, and he's basically done, and it's 5 weeks in, not even. So look, however you feel about it, there's no question there's a new sheriff in town.
Yeah, his endurance is pretty spectacular.
It's amazing.
From everything I've seen. But we are going to see the Fed minutes this week. Do you guys anticipate any surprises?
I think the Fed is much less relevant, to be honest. We hear a lot of speeches after the meetings. We just heard from Jay Powell. So I don't think it's going to be much of an information provider. The Fed is on hold right now. The inflation statistics confirm that, and they're just in wait and see mode.
I can't imagine what would need to be true for them to lift it. I also can't imagine what would need to be true for them to drop it. So right now, the reality is we're, I think, in a tipping point between inflation and recession. And they're just sitting tight. They've got a lot of powder in either direction. The good news is if we end up seeing the economy start to really slow, they've got a lot of drops they can make to create liquidity. And if the opposite happens, we're already fairly high rates. The long-term rate will automatically adjust up. It happens very quickly. And Peter, I've noticed the swings we're seeing on the 10-year are automatically doing the job that the Fed needs to do fairly consistently. Like, we're seeing these 30 and 40 basis point swings in the course of a couple of days. So I think the market is kind of trying to figure out where this new equilibrium is anyway.
Yeah, agree. The bond market is taking control of monetary policy.
And then the initial jobless claims will be out this week. And how does that tie into inflation?
I think Peter, we both agree that is the number. Like the truth is, employment is what's going to drive the Fed, because it speaks to the recession and it speaks to inflation. Right now, Peter mentioned it already. People's pay, even with the increases, are not keeping up with what's happening with inflation. And so the question is, do people keep getting jobs? It's been sort of squishy employment reports lately. Does that continue? And if not, then there'll be if the employment reports are good, the Fed's really not going to do anything for a long time. So to me, that's the canary in the coal mine for me, is the employment reports and what's happening with pay.
Well, I'm looking forward to hearing what we have to say about that next week. But I want to wrap up today. Thank you so much, Peter, Scott, and Joe. Thank you so much for watching today for Rise Up. We're just getting started. Remember, we want to hear from you. What topics are really interesting to you? What questions do you have? Please comment on our show and also subscribe so that we get to see you every week. And if any part of today's conversation really got you interested in a portfolio review or to understand a little bit more of one of our trusted RIAs like Scott and his team, just go to wealthion.com /free and click in so that you can get the description and sign up, and we'll be happy to help you. We'll see you next week.